The banking sector is in crisis. On March 10th, the biggest bank failure since the global financial crisis in 2008 occurred with the collapse of Silicon Valley Bank. 1 week later, Signature Bank gets shut down, followed by First Republic Bank being propped up with $30 billion. And on March 20th, Credit Suisse has been bought out by UBS for $3.3 billion in order to prevent further crisis. But it still sent banking stocks plunging into the red all across Europe and America. So let's discuss all of the details about what's been going on in the past week. Despite being 15 years on from the last financial crisis, it's very much clear to see that there's still some systemic problems within the banking sector.
We are in a very challenging situation. We need to address that.
So let's start off by talking about what happened to Silicon Valley Bank. Silicon Valley Bank, as the name suggests, is actually a bank that largely supports the tech industry, which has been absolutely booming in the past couple of years. Tech startups have been able to raise plenty of money from venture capitalists, along with just cheap money more generally, with interest rates historically being low, and as a result, had some pretty hefty deposits over and above that of the £250,000 insured limit by the Federal Reserve. But with the post-pandemic economic landscape evolving, SVB were facing into some huge problems. Firstly, they didn't have enough income. For some context, the way that banks make vast amounts of money is through something called fractional reserve banking. And here's how it works in practice. If you deposited £10,000 into a bank, typically the fractional reserve of this money held in liquid cash is up to about £1,000, which means the other £9,000 can be loaned out to other people. Now the interest rates on that loan is, let's say, 6%. But actually the amount that you're given in interest on the deposit that you made is only 2%. The difference between the two is the bank's net interest rate margin, which is exactly how they make money. But with that comes some major flaws. As I've said, Silicon Valley Bank's customers are tech startups who have access to venture capital, kind of like you see on Dragon's Den.
And I'm out.
So in short, they didn't really need SVB to provide them loans in order to fund business operations because the businesses were already rich in themselves. And it just so happens between 2020 and 2022, SVB actually saw a tripling of their deposits, but they had no real way to make an income from it. So they did what you could arguably suggest is a sensible thing to do, and they actually bought $21 billion, mostly consisting of treasury bonds, for a steady rate of return. The only downside being they did this during the pandemic when interest rates were low, and treasury bonds are massively sensitive to a change in interest rates because interest rates and bond prices are inversely correlated. So when interest rates go up, bond prices come down. So SVB's risk management department clearly didn't anticipate the massively changing economic situation, which would involve the federal fund rate rapidly increasing from next to nothing right the way up to 4.75% in less than 12 months. That resulted in the value of SVB's assets which they bought declining significantly. So whilst SVB's asset base was declining in the short term, you could certainly argue that wouldn't have been too much of a problem, driven by the fact that deposits were still coming in and they still had plenty of liquidity. But with that, herein lies the second problem. The cash burn rate of tech companies has massively increased. We've all seen it in the news. There's been this risk-off sentiment towards tech stocks. Now money has become more expensive to borrow. You've seen the likes of Meta and Amazon with huge scale layoffs, along with just the overall performance of the Nasdaq in the past year. The result of which these smaller tech startups are now relying on their cash deposits to actually continue to fund their business ops. And with this cash burn rate increasing, it put pressure on SVB's fractional reserves, which unfortunately led to SVB selling their treasury bonds for a $1.8 billion loss. So not only would they now have a big fat loss on their profit and loss account, but it's also a case of that money that was deposited in the bank itself actually being worth less now than what it was when it was deposited. And as you'd expect, as this news broke, there were fears running around that the bank could become insolvent. A run on the bank began and $40 billion in customer deposits was withdrawn from the bank in one single afternoon.
What do you mean the bank is out of money?
Now, to prevent utter chaos ensuing due to a complete lack of confidence in the banking sector and having flashbacks to 2008, the Federal Reserve actually came out with some unprecedented measures, those being to cover all of the Silicon Valley Bank deposits to reinstate that confidence.
I can reassure the members of the committee that our banking system is sound and that Americans can feel confident that their deposits will be there when they need them.
But despite that, it certainly shows the potential of catastrophic issues playing out as a result of rapid change in monetary policy. The chief economic advisor for Allianz explains it really well.
The Federal Reserve for too long kept financial conditions too loose, interest rates at zero, pumping in liquidity. Then it mischaracterized inflation as transitory for almost a year. And then when it finally recognized that we had a problem, it then embarked on one of the most front-loaded interest rate increases, literally like slamming on the brakes. And that caught certain institutions offside.
Some people will certainly argue that SVB should have anticipated changes in the economy and should have positioned themselves appropriately, rather than having a huge amount of their liquidity tied up in long-term investments. On the surface of things, it sounds like a sensible hedging strategy that was just completely poorly executed, which, to be frank, is probably no better than a reckless hedging strategy with all of the risks overlooked altogether, because the outcome is invariably the same.
Insolvent!
Which leads me on quite nicely to talk about Credit Suisse. Because whilst the likes of SVB and other mid-tier banks can certainly create some nervousness within the banking sector, it's nowhere near something like a failing of a G-SIB, which stands for a globally systemic important bank. Now, a GSIB is a collection of the top 30 banks whose positions hold such importance that if they were to fail, it could cause a financial crisis. And funnily enough, Credit Suisse is on that list. Now, without getting too wildly technical here, this GSIB framework was actually put together post-financial crisis. And this framework was put in place to consider the size of banks, their interconnectedness, the lack of readily available substitutes or financial institution infrastructure for the services they provide, their global activity, and their overall complexity. And based on the outcomes of those 5 core areas, a score would be applied, whereby the higher the score, the higher the capital requirements as a percentage of the bank's risk-weighted assets. Or in simple terms, the bigger the cash buffers that a bank needs to have. And that's so if in the event that there are any kind of financial pressures, that these global big banks can simply stand on their own 2 feet. But Credit Suisse have had a vast amount of financial pressures in recent years, which has simply caused shit to hit the fan. You really won't believe some of the stuff that they've been up to that's resulted in their own self-inflicted downfall. Let's start off with a couple of litigation issues. And there's a long list of them over the past 20 years or so, which calculate to $11.5 billion in penalties being paid. Now, on the surface of things, it certainly looks like a culture of poor commercial practice, which has kind of been almost fueled as the penalties as a result of that just being a cost of doing business. But with that certainly comes its consequences in the form of reputational damage. Let's take a look at some of the recent cases. Starting in 2021, a $175.5 million settlement was made after admitting to defrauding US and international investors in the financing of an $850 million loan for a tuna fishing project in Mozambique. Top Credit Suisse execs were found to have been accepting bribes where a portion of the funds were unaccounted for. One of Mozambique's contractors later found to have secretly arranged significant kickbacks worth at least $137 million, including $50 million for bankers at Credit Suisse, which were meant to secure more favorable deals on the loans, and that's according to the regulators. But that's not the only scandal that they've had to recently settle on, because we've also got the Archegos loss, where Credit Suisse took a $4.7 billion loss in relation to the hedge fund scandal, which again has Credit Suisse poor risk management culture written all over it. Through dealings with Archegos via the Credit Suisse investment banking unit, massive swap positions were built up in a number of different stocks. Now, a swap is a type of derivative which is highly leveraged and high risk. Now, unfortunately, the value of those stocks went on to fall, leading to Archegos forcing liquidation of more than $20 billion. A risk profile which was simply overlooked by Credit Suisse but exposed them to massive loss. Now, they are just 2 of the many scandals that have taken place, but they've led on to 2 further big things happening. The first one being profitability decline. Credit Suisse went from $3 to $4 billion in earnings in 2017 to making a loss of over $6 billion by 2022. The second thing being stock price declines. The stock is down 94% in the past 5 years as profitability falls and reputation damage continues. As a result, the appetite for shareholders to still own an interest within the company is massively deteriorating. Some serious red flags for investors, but then just 6 days ago came the final nail in the coffin. Auditors PwC concluded that the group's internal control over financial reporting was not effective, and that there were material weaknesses within that reporting. That's like setting off an internal bomb with Credit Suisse credit default swap surging, which implied a high likelihood of default. Further to that, Credit Suisse then went on to borrow 50 billion Swiss francs from the Swiss National Bank in order to shore up their own liquidity, and to ultimately give them a lifeline, only to end up conceding with UBS late last night actually buying Credit Suisse for just $3.25 billion, which was just a fraction of what the bank was worth just on Friday last week. So a 167-year-old bank has simply just been swallowed up, which of course makes everybody nervous. So with crisis across some of the US banks and one of the big failings in one of the European banks, how do the UK banks stack up, and are our deposits fundamentally protected? Well, I think it's important to recognise that the Bank of England have come out and said and confirmed that the UK banking system is well capitalised and funded and remains safe and sound. And even the HSBC UK CEO agrees as well.
Banks in the UK are in a very different place. And that's where you've got to really congratulate good, strong regulation. I know we sometimes complain about it, but it's good. And here we are now, we're in a safe place. Banks are very well capitalised, great liquidity pools. I think it's very different from 2008.
I keep seeing and hearing a lot about this contagion risk. Like other banks will be affected by the bad practice of others. And whilst you can never say never, I simply don't think this is a great financial crisis playing out again. Banks are in very different positions now than what they've been historically. And the likes of Credit Suisse have been a car crash waiting to happen for many, many years. So to compare the likes of Credit Suisse and even SVB Bank to some of the more traditional banks over here in the UK like HSBC, Lloyds and Barclays, I think is no more than a bit of fear-mongering. But of course, with that fear also comes opportunity. Opportunity in the form of a cryptocurrency resurgence. Ironically, as the banking crisis evolves, investors have flocked towards Bitcoin in particular, with the price rising 38.5% since SVB collapsed. It's super interesting to see how fear in the traditional banking industry has resulted in optimism in the cryptocurrency space, but be sure to let me know what your thoughts are on that down in the comment section below. Nonetheless, I do very much believe that this will just be some short-term banking crisis, and in actual fact, I think anything that's badged as a crisis in the press is usually just a little bit of hysteria, and actually over the coming weeks ahead, I think everything will quiet down once again. So that said, guys, they're my views. Be sure to let me know what yours are down in the comment section below. And with that said, YouTube recommends that you should now click on this video here. But before you go, be sure to subscribe to the channel on the way out. With that being said, see you over in the next one.